So when it comes to investment, right, so I like to use a framework, all right, because it keeps things into perspective, like what is the game plan? And this is very important, especially in these times like COVID-19 or 2020. So during these times of uncertainty, how do we actually invest with confidence, right? It's basically to have a framework like this. My framework will consist of 4 things, all right? So on the left-hand side, we have profitability and stability. So on the left-hand side, we have the quality, all right, fundamental quality kind of framework, kind of a criteria, okay? The first 2 is about the quality of the stock. And then we have the right-hand side, which is about the valuation. All in all, to me, the more important incomes are net interest income and wealth management income, because these are more recurring in nature, okay? It's like you have mortgages, you take out a mortgage, all right, to buy a house. You're not going to pay interest for just one time only. You're going to pay it for many, many years down the road. So it's actually recurring income. Life insurance is also the same. You buy an insurance policy, you don't just pay for 1 year, you pay for many, many years to come. And even so for asset management, especially when you have asset under management, typically speaking, if you have a portfolio size so big, right, you are going to get yearly fees, all kinds of investment fees, right, on a recurring basis. So all these things are recurring income, which is something that is very attractive to me as a dividend investor. So if you have an increase in net interest income, like I said, net interest income increase, wealth management income increase, you have a very stable cost to income ratio, which means stable cost control, and you can keep your non-performing loans ratio at a lower level, right? And also you have additional profits from Ningbo Bank, right? You should have an increase, a consistent increase in net profits, all right? And when it comes to shareholders' earnings, right, this is how it looks like for OCBC Bank. As you can see, it has increased its core net profits in 2008, where it has increased from 1.5 billion Singapore dollars to 5 billion 1.5 to 5 billion in the span of 11 years, where the compound annual growth rate is at 11.6% per annum. All right, so this is actually the kind of stock. If you ask me, right, what kind of stock how do I know whether this is a good stock or not? So one of the ways, right, the fastest way to actually find out whether or not this stock is something that I will invest, right, is summed up by this graph over here, lah. As long as you can see the shareholders earnings go up like this on a very, very consistent basis, then this is something that I will pretty much want to look at, lah. You can use your own what you call judgment to actually judge this, lah, okay? So let's say, for example, you are the type of people who says, okay lah, I'm gonna assess it not based on COVID-19, because it's not to say COVID-19 will be there forever. It's actually the actual earnings ability that I'm looking at. So what you can see is that if you base it on the actual, right, obviously your current PE ratio, right, is actually even below the 12 years lowest, because the 12 years lowest is 9.1. So therefore, if you have a PE ratio of 7, obviously you're going to think that it's very undervalued, lah, all right, because it's even lower than the 12 years lowest. And when it comes to dividend yields, it's very subjective, okay? If you want to have the COVID-19 impact, right, of 3.67, you put it here, 3.67, then of course, you are going to get a little bit, your dividend yields will be a bit below average, lah, the 12 years average for now. So it's really, really dependent on whether or not how you see things already. So in this webinar, I've already shown you the calculations, the steps, but then it's up to you guys, all right, the audience, on how you use these figures, right, to determine whether or not this OCBC bank, is it undervalued, fairly valued, or is it overvalued, especially during these times. 2 key things I would like to add on to you guys that you may want to consider when you are choosing between a Malaysia bank and a Singapore bank. All right. One is about this geographical reach, because Malaysian banks have lesser in that sense. Singapore has it. And number 2 is technology, very important. So it's because we are now living in the 21st century. So you want a bank which is very well equipped and prepared.